The Reserve Bank has upped the OCR stakes with a peak of 5.5% now expected. A recession has also been signalled next year as the tightening cycle takes heat out of the economy. Well, to discuss ASB Chief Economist Nick Tuffley is with us. So, Nick, the RBNZ remains in a hawkish mood.
Yes, extremely. We were expecting a 75 basis point lift and had been forecasting a 5.25% cash rate. And even we were quite surprised by just how much the Reserve Bank has upped the tone.
So they even considered 100 basis points.
Yes, they considered a 50, a 75 and a 100. I think the fact that they've thrown 100 into the equation there just sort of really illustrates just the change in debate that they are having internally at the moment.
Would that be an extreme measure to go 100 in this tightening cycle? And would that sort of feed into possibly a harder landing for the economy?
Well, they wouldn't be the first to do 100, let's put it that way. The Bank of Canada, for one, has done that sort of magnitude. I think when we're getting what I'd say is towards the end of the tightening cycle, it may not feel that in terms of basis points, but time-wise getting a bit closer to it, it does have a little bit more risk around it in the sense of going large and then finding out, whoops, that may have been a bit too much. But look, they could have easily done it, particularly given that they've got a 3-month wait until the next opportunity or scheduled opportunity.
Yeah, what data do we have between now and then?
We've got pretty much the whole gamut of data you normally get over a quarter. So we're going to have GDP come out in December, and then we'll have some of the really key data, such as we're going to get inflation in January, we're going to get the employment, unemployment and wages at the start of February, and we're going to get the Reserve Bank's next survey of expectations, which will have that inflation expectations data in it about mid-February. And look, that's been quite key. It was one of the things that got quite a lot more air coverage in this monetary policy statement after the jump that we had in the latest survey.
Where do you put the OCR peak at ASB now?
Well, we have actually nudged our forecast up from 5.25 to 5.5. I mean, that isn't in line with what the Reserve Bank is saying. We do feel that we need to take them, reasonably at face value at this point. It is going to depend on that data flow over the next, 4 or 5 months as to whether we actually get that high. But given the Reserve Bank's really got the bit between the teeth, we felt they're probably odds-on likely to do another 75 points in February. And they probably, if they do another rate hike, it's probably not going to be a small 25-pointer after that. And that's the main reason why we've picked 5.5. Big moves are what the Reserve Bank's likely to continue doing.
They're on a different path, really, to the Reserve Bank of Australia, which has gone down to 25 basis point instruments.
Yes, there are some contrasts, at least at the moment, between the two countries. I mean, one is that the Reserve Bank of Australia is probably getting a bit more bite and a bit quicker. Household debt levels are a lot higher compared to incomes, and the flow through to households is coming through quicker. Also, this wage story doesn't seem to be nearly as strong in Australia as what it is here. So that's one of the key differences. In New Zealand, we're expecting very persistent wage inflation for a long period of time, whereas Australia, they're not expecting that, and they are getting a lot more inbound net migration as well to just help alleviate the supply side constraints. And that's what we're probably not going to see here in New Zealand.
Well, let's go to inflation. Interesting, the governor wasn't so sure inflation had peaked today, whereas in the past he sort of had made the point that he thought inflation had peaked.
Well, we do think it has likely peaked where it is now, but it's just going to be quite slow coming down. And look, one thing that was notable in the Reserve Bank's forecast is that they do have a much stronger inflation outlook in the near term, and that will be causing them that added concern. It's the longer high inflation lingers, the more chance of inflation expectations. So our behaviour around inflation changing, and that's increasingly a concern that's crept into the Reserve Bank's decision making.
So they're being kept on their toes at every step of the way with all this new data coming in.
Yes, they certainly have been. Look, we've had the tightening cycle going on for over a year now, and even 12 months into it, the Reserve Bank was still getting quite surprised by some of the persistence of inflation. And that's sort of really one of the things that's driven it to just go, look, we just need to get ahead of this.
And there is always a lag, but is the lag slower this time?
The lag generally does take a reasonable amount of time. We've had people tending to fix for 1 or 2 years with their mortgages recently. We've probably still got over the next year nearly half of all fixed rate mortgages by value still to refix. So it's still taking, in our view, probably until 2024 until you're seeing the absolute full impacts flowing through across all households. So it is taking time to come through.
And it appears 2023 will be the year of recession.
Well, according to the Reserve Bank, yes, they're essentially expecting the economy will decline about 1% next year. So we're not quite that, shall I say, pessimistic. But look, it's pretty clear one way or other growth is going to be pretty flat. So it is going to be a challenging time, and it is going to be households mainly who are bearing the brunt of that through the high debt servicing costs having an impact. At the same time, there are some encouraging signs on sectors like tourism, which used to be a very, very strong earner, but very subdued growth outlook, and it's the households that are feeling the pressure.
So business consumer confidence will stay in the doldrums at the moment.
I think we're likely to see businesses and consumers to have not a huge amount of cause for great cheer and a lift in confidence at the moment. There's still a lot of uncertainty around, and I think that the fact that Reserve Bank hasn't finished lifting interest rates and is lifting them at a fast pace will still be creating that. Well, where does it end? What impacts is it going to have? That story is still going to be hanging around for a while, and we still have a pretty murky global environment as well, with rising interest rates there, war in the Ukraine, and China and its zero COVID policy. All those things are having an impact too.
What's 2023 going to look like for the labour market and wage inflation?
What we're likely to see is like a gradual lift in unemployment, and that's going to be coming about not necessarily by a whole lot of people losing their jobs. It's just more that we probably won't be creating jobs as fast as what we're seeing, a rise in the number of people who are wanting work. So that's likely to see that pressure ease. That will make it a little bit easier for businesses to find people. We'll see that wage pressure starting to reduce. But in the short term, we're expecting that wage growth will pick up a little bit further. But that labour story, very, very key, because the really longer term persistent inflation pressures are generally going to be driven by the strength of wage increases. And if we don't get the productivity growth to go with that, then what that's doing is just simply adding to the cost of doing business and will flow through to inflation.
So February decision, are you expecting the Reserve Bank to hike again by 75?
At this point in time, yes, we think they'll do another 75, just given the clear urgency they've got. Look, the caveat is that's 3 months away, and we know just about anything can happen in that period. But if they're still getting signs that inflation's looking pretty strong, they're likely to go. They can perhaps think about easing the pace back if they're getting some clear signs that inflation pressures are moderating. So inflation expectations starting to fall noticeably, unemployment rising, wages potentially even cooling, as some examples of things that might make them feel a little bit more comfortable.
Nick Tuffley, thanks for joining us.
Thank you.